Hey guys, it's Bobby again with GrowthView, and today I'm here with Kelsey Olson from Capital Realty Group and Compass. And Compass is a modern real estate platform that pairs talent with technology to make searching and buying a home easy for first time home buyers and investors. And what I really appreciate about Kelsey, she has some great perspective she can share. She's an agent, but also as an investor focused on 2 to 4 units. And I know there's a lot of conversation that we hear on a lot of these podcasts, like Bigger Pockets, where we talk about the Burr approach, how to scale Airbnbs and different things like that. And Kelsey has some incredible insights that we're going to dive into today on unique ways in which you can approach some of these styles of investing. And without further ado, we'll dive in. Kelsey, hey, thanks for being here with us.
Yeah, thanks for having me. I'm excited. This is fun.
Yeah. So, to start off, tell us a little bit about where you kind of connected the dots from, where you were before you knew about real estate and just being an investor and an agent to where you are now. I know you have a unique story about just like your relationship with money and just growing up. So tell me a little bit just about like what got you here.
Yeah, no, absolutely. It's a great question. So, I grew up in Iowa, right? And in the Midwest, I think specifically, a lot of the times we have learned and been taught the approach, work for the man, save your money, live below your means, grow your bank account, right? And so we're never really exposed to the idea of investing in real estate to build wealth or really investing as a whole. And a lot of the reason is because in the Midwest, property really doesn't appreciate that much. So typically there, you buy a house, so that way you pay it off in 30 years and then you don't have a rent. But then I moved to California and I was like, all of these people have so much money out here and they're not smarter than I am. What are they doing that I don't know? And then I really started getting exposed to the idea of, oh my gosh, they're investing their money. They're leveraging their capital. They're making money without doing things because I can only work so many hours in a week. And no matter how many times I do that, there's only so many hours. So working for the man typically is not going to build you that long-term generational wealth that you can actually achieve when you leverage your capital in the right direction. And using real estate is really one of the best ways to do that.
Absolutely. So to kind of frame this conversation up for our listeners who are, typically investors who want to be a part of a syndication, or maybe they want to in the future, tell us a little bit about why you have a focus and a specialty on the 2 to 4 units and just how maybe people can get started to build their portfolio to, reach some of their goals to become a passive investor.
Yeah, absolutely. So my team and I really like the 2 to 4 unit space for a couple of reasons. One, because you can still get residential financing on a 2 to 4 unit. So the property is based on if I qualify for that property, it's financed and underwritten just like a single family property or a condo or a townhome would be. So that makes the financing piece a lot quicker and a lot easier in most scenarios. The other reason that we really like the 2 to 4 unit space is that it diversifies and mitigates some of the risk associated with investing in a little bit more expensive markets, because now you have 2 units or 3 units or 4 units bringing in rent instead of maybe a single family home. So if you happen to have a tenant that moves out and it takes a week or two to get one in, you still have 2, 3, 4 other units offsetting some of that rental loss. So it's a really, really big way to have some risk mitigation. And it also puts you in a little more of a unique space because it's a lot of mom and pop investors in this space. And it's kind of a missed area, right? So a lot of people know about the syndications and the bigger deals. But if you're just getting started or you're just trying to understand what's the best avenue for me to go, the 2 to 4 unit space is really great because it's a low barrier to entry and it's not as super prevalent, I think, to a lot of first-time buyers that don't really understand or know much about that space.
Right. And are you focused more on like long-term rentals or short-term rentals? Tell me about the strategy that you're using to create success for yourself in this space.
Yeah, absolutely. So I use actually a little bit of everything. I do long-term tenants, I do straight Airbnbs, and then I also do the midterm rentals, they want to say. So anywhere from a minimum 30 up to 90, 180-day leases. And we really like that space. And, it's kind of the mid-level. So any sort of rent control or rent restrictions they have around short-term rentals, the minimum is always 30 days. if you're doing a 30-day minimum, you're not subject to any new Airbnb policies. Or if you're in a condo or townhome, the HOA still has to allow anything greater than 30 days. So it kind of circumvents any policies that may be in place that don't allow short-term rentals. And it also allows you to create a lot more cash flow than you could off of a traditional long-term lease. I use the platform specifically called Furnished Finders. It was initially set up for traveling doctors and nurses, but I also see a lot of military on there, a lot of corporate business travel on there. It's basically a platform that hosts a way to connect owners, landlords, property managers to professionals seeking these midterm rentals. And you can get anywhere from, 30 to 65% higher rents, because a lot of these people that are going to rent it, their companies are paying for this, right? So they have a higher stipend and you can charge more than you could on a traditional long-term lease.
That's awesome. So whenever you're approaching different deals, I guess you have multiple lenses which you can look at it through. Like, so are you actively just seeking out these deals that you're doing based on very specific criteria? Like, hey, I really like Furnished Finder in this area, or is it really, we're looking at everything? Because I guess my mind goes down the rabbit hole of, there's a lot more risk, I feel like, on just doing long-term renting at this point, where there's going to be a lot of security in the medical field. I remember in college 8 years ago, we had a shortage of nurses. I would assume we still have a shortage of nurses now. But tell me about how you approach these deals, and are you having to get involved with a ton of rehab or repair, doing like BRRRR, like some of these popular strategies, or are they just operating efficiently and getting great returns out of the gate?
Yeah, so every property is different, as you know. I have a duplex, and that one was a BRRRR project. So I had to completely kick out the tenants, fully gut, fully remodel that one. And based on the square footage and location, it made more sense for me to long-term lease that one. Now I have a property that's closer to the beach and in a more desirable area for people that are maybe traveling, that are only on a short-term lease, and they have a little bit higher income. And that I specifically knew I could get a lot more rent doing the Furnished Finder method or the midterm rental method. And in that situation, I didn't do a lot of rehab because the property was in pretty good condition. I refinished the floors, I painted it, put some new epoxy in the showers, made it look clean and simple. But the best thing and the most advantageous strategy for doing these midterm rentals is think similarly to what you do on Airbnb. It needs to look cute. It needs to be appealing, right? That doesn't mean you have to spend a ton of money furnishing it. I furnished my entire place off of Facebook Marketplace and OfferUp. I just found really nice stuff that looked good and it fit a certain aesthetic. And that's what's going to rent your property, is a certain aesthetic and a certain location. So depending on where you're targeting and which property and which method, I would have a different strategy to say. You're obviously always going to make more money doing the midterm rentals, but if you're in a location that's maybe not quite as desirable for a midterm rental, you might have a little bit higher risk and a higher vacancy rate, where I might just give you the advice of, hey, it's probably the best to just put a long-term tenant in there, because it's going to just be an easier go at it, and over the whole year, it'll probably even out to be the same. But if you're in a more highly desirable neighborhood, I would absolutely do the Furnished Finder rent. I never have vacancies. I always have people lined up. So
Awesome. And have there been, like you mentioned, Facebook and OfferUp being great tools you can use to find affordable, items to furnish the home. Have there been any other tools, or maybe not shortcuts, but things and just assets just within your disposal you have used to help create success, to really get off the ground quick and create success for yourself?
I would say just kind of like looking at other listings, right? It's kind of like anything else. You go out there and you kind of do some comps, but then your area, and kind of thinking about what you want the vision of the property to look like. So you can't just go out and say, I want a couch and a table and a picture that doesn't really doesn't go well together, it doesn't flow. And I'll be the first person to admit, I am not a good interior designer. That is not my strength. I'm a numbers person. I'm a strategy person. So I was a little like, okay, this might be difficult for me. But you just kind of look at pictures, you look at other things, like what is the vibe I'm going for? And my best advice that I did is I found one thing to start with. So I found a really, really cool dining room table that had a mid-century modern vibe. It was very affordable and in good shape. So I said, okay, this is what is going to be the focus of this rental. So now I have some sort of strategy or pivot point that all my furniture and furnishings need to kind of fit this mold. So it's not just random pieces all over. And that really gives it a really cute look and vibe. And I know it sounds silly to those of us that are invested in numbers, but it makes a big difference because people really want that experience, especially for the short term.
Yeah, no, that's a really good point. Yeah, I think if you can differentiate yourself, make it a good experience, that's very compelling for people to make them to want to take action. That's awesome. Now let's talk a little bit about, you had shared with me how real estate investing, it has helped you get maybe better returns and just more, maybe, I don't know if safe's the word, but I've just noticed the volatility in the stock market lately has just been a bit wild. We've kind of been in a 10, 12-year melt up. Everyone's a genius. You just put money somewhere and we make money, but it's starting to get a little challenging, I would say, to, deploy capital and get, a consistent good return. Like, what keeps you attracted to real estate compared to equities or other assets moving forward? And express that and explain that to our listeners.
Yeah. So for me, you kind of just look at the math and the numbers. And I will say, I'm sure you guys preach the same thing. The most important piece about real estate is having a good market, right? So if you are investing in a solid, economically stable, economically growing market, real estate is the safest investment you can have right now, especially when you're trying to hedge against inflation and you just look at the basic numbers and the return. So I think about it this way, and I explain it to my newer investors this way. I'm like, if I have $100,000, for example, I can put my $100,000 in the stock market and I hope at best, 7, 8, 9% return. But that's only based off of $100,000. If I take $100,000 and I buy $1 million property, now I have $1 million appreciating asset compounding. So, the math, when you do a spreadsheet, and I always do it for people because, the numbers never lie, right? You just model it out for them and it's just astronomical, the type of gains that you can get in an appreciating market because of just the basic concept of leverage, having $100,000 that can now bring you something appreciating at $1 million versus $100,000 appreciating at $100,000. Even if the appreciation was the same, which traditionally real estate in a good market is greater than the stock market. But even as a risk averse tool, it's never going to be worse.
Yeah.
And then if you have cash flow, you're even double dipping, right?
Yeah, absolutely. And I know for you, you're a real estate agent, so you get some special incentives within the tax code as far as write-offs on being active, but also a passive investor. Can you share any insights or just tips for people that maybe do want to go full-time into real estate? Because again, our listeners, they're really focused on maybe long-term becoming an LP and a passive investor, but a lot of times, they do make the jump and they make the shift to doing active management because it's a ton of fun, hunting down deals, finding numbers that line up. Like, what type of benefits could you maybe share with people that they get by, going into real estate full time?
Sure. So one of the best things that there's available right now is it's called a cost segregation study and bonus depreciation. So the Trump put in place a tax code that allows you, when you do a cost segregation study, to take something that's called bonus depreciation, which depreciation is made up, right? It's just a made up term by the IRS. It's not real. It's just another way that people that invest in real estate don't have to pay taxes or as much taxes, right? So it's kind of one of those things is like, don't hate the player, hate the game, and learn to play the game. So the cost segregation study basically allows you to take pieces of your investment. So when you depreciate an asset or a real estate asset, there's different segments of it. There's 5 years, there's 7 year, there's 15 year, and there's 27.5 years. Traditionally, we would just take a peanut butter spread, 27 and a half years, say it equals, I don't even know, 10K a year, right? And that would be your write-off. But if you do a cost segregation study and you take what's called bonus depreciation, you're allowed to write off your 5 year, your 7 year, and your 15 year pieces all up into year one, which can be hundreds of thousands of dollars, right? And that is a passive offset. So if you're not a real estate professional, that's still a passive offset to a passive gain. So say you made $100,000 in the stock market and you wanted to take it out and just go spend it. Now you have a passive loss coming to offset a passive gain. So you're not going to pay taxes on that. Now, if you are a real estate investor or a real estate professional, the really cool thing is I can write those off against my actual real estate income. So I did 2 cost segregation studies for tax year 2021 on both of my 2-unit properties. And my entire write-off amount is $466,000. So I get to take that against all of my income. And because I'm married, I also get to take that against all of my husband's W-2 income. So basically, we're not going to pay taxes in 2021 because of leveraging this, cost segregation and bonus depreciation. And it's not a well-known thing. A lot of the tax attorneys and accountants don't even know about it. But it's a really, really big tool, especially if you're moving money around or you don't, you want to figure out how to not have to pay a bunch of taxes.
Awesome. So the cost segregation studies and the bonus depreciation, that can actually write off, like you mentioned, like stock market gains and just other gains, like anywhere in your investment portfolio.
100%. It could even offset, say you actually made a bunch of income from your investment property, say you're cash flowing a bunch. We don't cash flow a lot here in San Diego in the first few years, but if you're in a different market where your cash flow is high, you can do this bonus depreciation and cost segregation. It'll offset your income from your rental properties. And the other really, really cool piece about the cost segregation is any of the write-offs carry forward into the next year. So let's, for example, say, hey, I made $50,000 of rental income. I have $100,000 of passive offset from this cost segregation study. So now you have a 50K delta. That 50K delta will carry through to tax year 2022 or tax year 2023 and serve as a write-off for any of the income in those years as well. So there's really not a negative to doing this, especially if you have incomes coming in from other places. It's a really cool product.
Yeah. So if someone, let's say, got their first, duplex or quadplex in the next year and they wanted to get a cost segregation study done, what type of, tax advisor or who would you recommend that they reach out to get that done?
Yeah, absolutely. So there are actually companies that do this. I use a company called KGKB, and there's a few different companies that specialize in doing the cost segregation study, and you do have to get it done professionally. They do a whole workup, and they itemize all of your assets and, give you these reports and all of the data. And then you take that to your accountant, and then they, process that as part of your tax returns for the year that you're going to take that cost segregation in.
Awesome. That's great. Now, as far as some of the deals you've done in the past, like with the properties you have now, have there been any headaches or things that were unexpected that maybe you could express to new investors to kind of keep them in reality? Like I've had a couple of nightmares myself managing, but have you had any tough situations that you've had to overcome and manage?
Yeah, so this is actually it was a tough situation, but it's working to my favor. So for example, when I was fully gutting and remodeling my duplex, both of my contractors got hospitalized with COVID, and they were in the hospital for 2 months. And I was like, oh my gosh, that's obviously awful for them. Get better, no problem. But now my project is behind, at least 2 to 3 months. So I was like just burning cash because they were vacant, right? And so I was like, okay, this is what it is. I'm just going to have to put this as part of my bottom line. It, shit happens, right? But what actually ended up happening is the market appreciated so much in those additional 3 months that when I did a cash out refi, I was able to take out way more money than I actually lost on those mortgage payments. So my best advice is like sometimes, just roll with it and keep your eye on the prize, because at the end of the day, the big picture is still, it's all going to be worth it. But if you sit there and try to pick apart every $500, $600 bill and overanalyze it, you'll never do anything. And then you'll get in the analysis paralysis phase and you'll have missed out on an opportunity. Don't let, pennies get in the way of dollars here, So that's kind of a unique story for, the times we're in, I guess.
Yeah, absolutely. Now, as far as doing cash out refis and just managing risk right now, like as an agent and someone who probably has a little more insight than just say an investor who's getting started. What do you see going on like with rates and just like home availability? I know there's like, I believe when I spoke with Patrick, there's a shortage of about 10 million homes or so. So that's obviously going to make an impact. And we have a cohort of like the largest home buying group ever, millennials. So just from your perspective, what role do you see that playing in demand and just managing risk when it comes to, buying less than 4 units?
Yeah, so what we're seeing here in San Diego is the supply and demand is just so uneven and unequal. And the trajectory of that is going to continue strictly because we haven't built enough homes, as you mentioned. We have one of the largest cohorts. And San Diego is, a city that has a large cohort of millennials. Like, it's a younger city, it's a more, demographic city gearing toward that. So for us, the supply and demand, offset is going to continue well into the future. We're geographically constrained. We have Camp Pendleton to the north, Mexico to the south, desert to the east, and the ocean to the west. So land is just, there's not a lot of places to go. So, and what I predict to see this year is we will see the hundreds of K over asking, because that's what we've been seeing, 100, 200K on a really good single family home over asking. That will quell a little bit because obviously people's buying power will be restricted as rates go up. But I don't believe that we are going to see a reduction in prices. Everything that we've studied, all the data, all the economics projects that we're still going to appreciate a good 15% this year and at least another 10% this year. And then we'll probably even back down to that, 8-9% annual appreciation, which is just driven by simple supply and demand. And the fact that San Diego specifically is just growing in terms of industry. We have huge biotech boom happening here. We have Apple coming and Amazon coming. So what's traditionally been a blue collar workforce here is now gearing toward more highly educated, highly paid younger population, which, is exactly what you said, is usually that millennial population that's starting to buy homes for the first time and they're wanting to start families and they're now coming into that space.
Nice. So this is kind of, you might not have an answer to this, maybe you do, but the one thing I've noticed is there's tons of cool technology popping out. Like you have Furnished Finder, which is like Airbnb, but not, it's different. It serves a specific niche. I saw a website the other day, I forget what it's called. I think it's like Splashly or Poolly or something, where you can rent out your pool in your backyard for like 40 to 90 an hour. And I know it's in California, but tell me what you just think about all this new technology. I think they call it prop tech, like property technology, like just real estate related technology. But what impact do you see that just making on investing? Because me as an investor, why I didn't catch on to Airbnb earlier and like try to take advantage of some of these things. Like, I know that's something where it's just becoming, you have to be more aware as an investor. It's not just, meeting a broker and having numbers nowadays. Like, there's all these new things popping up. Like, what role do you see technology playing in all of this?
I mean, I'm all for it. I'm a big believer in like, hey, let's give it a shot. Let's explore it. Some of the things I think are going to be a little bit of a novelty and not really take off and not have, it's going to not be worth it. For example, if I'm running my pool for $40 an hour, I don't think it's worth it if I have one, right? Personally, but to somebody else, that might be worth it. And by all means, have at it. I'm a bigger believer in the more we can educate, the most we can learn, like the more ideas and options we can throw together. You never know what thought might spark another thought or what conversation might spark something that you never been thought of before, So I kind of treat everything as like a leap pad or a way to learn about something else I would have never thought of. I do believe some of it will kind of not be around forever, but I do think a lot of it will stick. And I think a lot of it's really great. Like the Airbnb stuff's awesome. A lot of restrictions come into different play into different cities, which is probably a whole other segment. But you know what, I think it's fine. I think it's great. I'm all about trying different things and seeing what works or what makes sense. And it's everybody's risk tolerance and personal choice,
Yeah, absolutely. And before we hopped on, you were talking to me about like it's easy for people to get deer in headlights thinking about rates. Like, oh my gosh, we're at 6-7%. It's the highest it's been in ages. But you raised a good point. How often do people truly own a home for 30 years? Like, talk about that just to kind of, again, bring people back down to earth, maybe who might have a little fear just because, things are changing.
Yeah, I mean, you nailed it. So like the average mortgage is 5 to 7 years, right? So people, you either are doing a cash out refi, you're moving, you're selling and moving up, you're keeping it. So I tell people it's kind of like our team said in 2022, right when the virus hit. We're like, right when it was brand new. So I feel like this is kind of that same opportunity. Rates are actually getting high and people are starting to freeze. So there's a little bit of space, right, where people kind of stop for a second before they adjust to the new norm, right? So I feel like in that space is an opportunity. So I tell my buyers, I'm like, this is an opportunity space for us here in the next few months before people really start being educated on the fact that rates will most likely come down in a year or two. Once we get inflation under control, we've put things back into perspective in the economy, I firmly believe rates will come back down. We're not going to see the 2s and 3s again, and that's okay, right? But they will get off the mid 5s and 6s. And you can always refinance. And if you're actually investing, you're going to want to do a cash out refi anyways. So that way you can keep leveraging and keep rinsing and repeating in the process. And I can tell you, I did an ARM on my property and I wasn't stressed about it at all. I'm like, I'm absolutely going to refinance this before 7 years. So it made sense for me to take an ARM or even maybe an interest only for some of your listeners to keep that monthly payment low if that's what they're after, knowing that I'm not going to have this for 30 years or even the term of 5 or 7. So another thing to consider is maybe start looking at your exit strategy or thinking about the bigger picture when you're taking on just one small thing. But again, don't let pennies get in the way of dollars here.
Yeah, absolutely. Yeah, my wife and I were moving out east and the rates came up and I was just like, oh God, you immediately have that response and like fight or flight. And then I'm like, no, we're going to control what we can control, the variables we do control. And if we best manage that, like we're only talking about a few extra $1,000s a year, we can manage that over the next couple of years to create a better outcome for us. And yeah, I love that you raised that point because I think people do forget it's only 5 to 7 years we often keep a home.
Yeah, this isn't the rest of your life, right?
Yeah.
Unless you want it to be. There's always options. That's the best thing about real estate. There's so many different directions. Nothing in life is permanent if you want it to be. If you're like, I'm over this property, okay, you made some money on it, sell it, move up, do something different. So yeah, I don't know. That's kind of my perspective. I guess it's easy because I do it every day,
Yeah.
But yeah, I wouldn't get too caught up in that. So, but yeah, you're spot on.
Yeah. Well, now as far as education, you mentioned education is really the big thing. And I agree, like with all these technologies popping up, it might cause people to like take a risk that's, not as calculated, like maybe lacking experience. As far as education, what has been the most valuable maybe tool or just resource for you over your career?
So for us, absolutely just studying the economy. I can't speak to every market because I'm not intimately aware of every market in the country. I don't have the energy for that. But what we really, really focus on is the data, statistics, and following closely the economics behind the market that we firmly believe in. And when you take the emotion out of any piece in life and you look at the numbers, you look at the facts, you look at the trends, it makes the investing so much simpler and easier because, it's like the stock market. Everybody wants to think that they will just look at the numbers and not, but we all emotionally do it. Oh my God, it's going down, let's pull out. When strategically, that's not the right thing to do and we know it, but people will still do it. So if you can kind of really retrain the way you look at things and you really do just focus on the economics and the data and the long-term trajectory, it will just make your life much less anxious and knowing that that's just the right thing to do and try not to get too emotionally stressed about, oh my gosh, rates have jumped a little bit. What's going on, what's going to happen. So for me, just really feeling confident about the economy of whatever market I'm in makes everything so much easier because then you don't get stressed. Oh, I'm behind two months on my rebuild, whatever. I'm going to make X amount of more dollars in the long term on this,
Awesome. And for you right now, I know you mentioned you have done like a couple of refis. Like, are you still actively looking for deals and are you seeing like good opportunities still in the market currently with where we are?
So I bought 2 multifamilies last year, so I got to give myself a minute to build up some capital again. But absolutely, like I'm still going to continue to buy. I'm going to wait another year or two and do a cash out refi again on my places. But I will continue to buy, specifically in San Diego. I will continue to invest because my goal is long-term capital appreciation, right? And building true generational wealth. And so I have a job, I make income, I live fine on it. So as long as my properties are still performing in terms of the long-term appreciation, and I believe in a market that I know, yeah, I'm very confident still moving forward. And I think that, rents specifically in San Diego have increased significantly this year, already 15%. So the economy is growing, the rent market is growing. And so you gotta, kind of still be strategic about what you're doing. But I firmly believe real estate, I'm all in. I'm not saying don't do an investment. I have a 401k, I still do that. But in terms of like knowing what's going to really provide me the most money when I do want to retire, I know that it's going to be these real estate investments, because I'll be able to take out hundreds of thousands of dollars, if not millions of dollars in appreciation. Or like you're saying, if I started when I'm, 30s or 20s or whatever, I've built all this equity. I say I started with 100K. I bought these properties and I let them appreciate. And now I have $1 million worth of equity in these properties. And I'm like, I just want cash flow now. Now maybe I say, hey, Bobby, go take my $1 million, put it into syndication, and let me get all that cash flow, right? Or I'll go buy a property in an area that gives me a lot of cash flow, or I just sell them and live on my proceeds, So there's a lot of different avenues, but I'm still all full in on real estate in terms of the real true wealth building. Yeah.
Yeah, no, I agree with you. And one thing I've been contemplating recently, I know it probably drives some people crazy hearing this, but canceling my 401k and just getting rid of it and just putting money into assets I can manage and things I can control and my own businesses, because I haven't really been happy with just like passive ETFs and like these simple things that these managers create. Like, so if this is personal, you don't have to ask it, but are you still actively like saving in a retirement account, or are you all in on like investing in yourself, controlling your destiny, and really like kind of actively managing things? Because I know like that's really where great returns are. Like when you look at like business owners and people that just bet on themselves, like what is your approach?
Sure. So I've stopped investing in my 401k. I do not want to give anyone a financial advice, right? But that's kind of where I'm at, because like you said, you have a little bit more control over your own destiny. You can see the leverage. And what a lot of times you run into in San Diego is what we call negative cash flow. We'll invest into a property and you won't be positive cash flowing based on the rent, or it's going to take you a minute to get there. So people will get very spun up about this concept. And I'm like, every month or every paycheck, you are negatively cash flowing into a retirement account. That's a negative cash flow event. It's the exact same thing if I have to pay $400, if the rent and my mortgage is a $400 difference versus if I have a $400 distribution into my 401k. They're both negative cash flow events. But you have to think, which one do I think in the future is going to give me the highest return, right? And typically with leverage, it's going to be real estate investment in terms of capital appreciation. So that's kind of been my focus, and where I put, my money where my mouth is. I tell my clients, I'm like, this is what I do. I wouldn't tell you something that I didn't do. Obviously, everyone's decision is different, but they're both negative cash flow, and if you can positive cash flow over here, even better.
Yeah. No, I agree. My mindset has shifted ever since I left. I worked at a marketing company for 10 years, left, joined a startup, created 2 businesses of my own. And I was just like, I need to stop working for the man. I need to create something myself. And that's what I love about real estate. Even being your own agent, you control your destiny. So I appreciate you sharing all this perspective today. And if people want to connect with you online, like what's the best place to reach out, follow, and just connect with you?
Yeah, so my Instagram is Kelsey Olson _SC real estate. You can Google me, find my email, phone number. I'm happy to reach out. If you Google me on I think the Compass page, and like the Redfin Zillow, and my business page will come up too. But yeah, I just like talking about real estate and helping people make money, right? I wish I would have known this when I was younger. So I could talk for hours. So if anyone's interested in hearing a different perspective, or like you said, really shifting the way you view money, because that's what it took for me, is an entire shift of the way I view making money, I'm happy to chat.
Awesome. Well, I'll be sure to put the link to each of those in the notes below so people can find that easily. But I appreciate you being on today and just sharing some of your story and just how you've been approaching your investing. Thank you again.
Awesome. No, thanks so much, Bobby. I really appreciate you having me.
All right. Bye.